we can.
On chapter 4, we'll look at the bond markets. So in the previous section, we had looked at the short-term securities that are traded in the money markets. And we also looked at how to calculate them. Okay, so now we're going to look at the bond markets that traded in the capital markets and how to evaluate them. So by the end of this chapter, we should be able to describe the main purpose of the capital markets, to identify the key participants in the bond markets and why they issue bonds, and also discuss the various categories uh, of bonds and also the features that bonds have, and to analyze the provisions for redeeming these bonds, and also to explain how the bond markets have become globally integrated. So we start with the purpose of the capital market. So capital market is for long-term investments. Primarily, we're dealing with firms or individuals that choose to borrow for long term to reduce their risks and also to have a larger return. So we have a lot of participants who are in the capital markets. So primary issuers in the capital markets are very important and central to the establishment of this market. So we are going to look at a bond. By definition, it's a long-term debt instrument that is issued by governments or corporations. So the bonds usually will promise to repay the borrowed money with a fixed interest at fixed intervals, which we call coupon interest. So bonds are issued as investment vehicles. They're a source of capital. So different types of bonds we're going to look at. They're what we call secured bonds. These ones are backed by specific assets like property or equipment. And these bonds um, offer low risk because investors can claim assets if the issuer defaults. So we also have unsecured bonds like debentures. These are not backed assets. They are only the issuer's credit worth is at stake. Okay, these ones offer high risk than secured bonds. We also have what are called junk bonds. So you need to understand these types of bonds in their context and um, understand when they're used because questions will come in them. All right. So we're talking about types of bonds before we go into the calculations. So the other bonds that we have, so we've talked about the secured bonds. These ones are backed by specific securities. And the unsecured bonds, like debentures, are not backed by any securities. Then the junk bonds, these are bonds that have credit ratings below investment grade, below the BBB, below the S&P. Okay, so the features of these bonds are they also offer high potential returns because they have high risk of default. These junk bonds are often issued by startups or highly leveraged companies or firms that are experiencing financial trouble. They are suitable for investors who are seeking higher returns and are willing to tolerate volatility. So the bonds are very attractive during times of economic growth, but they become highly volatile during default-prone downtowns. So we also have fallen angels or rising stars. So we have what we call fallen angels or rising stars. So these are bonds downgraded from investment grade to junk. So these are dynamic kinds of classifications that describe the transition of bond ratings over time. So there are bonds that are initially rated investment grade, but later downgraded to junk status due to deteriorating financial condition of the issuer. So they may still be attractive if investors believe the company can recover, and downgrade is temporary. We also have, so they're called rising stars. These are bonds that start as junk, but later upgraded into investment grade because of the issuer's condition improving. So they can start from fallen angels to rising stars. So they use these initials to explain the condition of their status. All right. So we also have So in this case, the classification is very critical in the for investors because we use the value approach to seek the undervalued or improving assets. So we also have callable bonds. So callable bonds are bonds that give the issuer right, not the obligation to repurchase a bond before its maturity. So usually at a predetermined price, which we call the call price. So here, issuers usually call the bonds when interest rates fall, allowing them to refinance at lower interest rates. So to compensate for this risk, callable bonds will offer a higher yield than the non-callable bonds. So investors may receive what we call a call premium or an extra payment if the bond is called early. So the concern for the investor here is that while there is a high yield that is attractive, investors may face a reinvestment risk. So this risk that the bond will have is called when the interest rates are lower. It is harder to find equally rewarding alternatives. So we've talked about the bonds generally. The type of bonds we have secured bonds. These are backed by a specific asset. The risk level is low and the return is lower. So these bonds have a special feature in that they're asset backed and they have what? Safer default. We also have unsecured bonds, which have issuers credit only. So the risk level is moderate and return is moderate to high. There is no asset backing. We have junk or high yield bonds. These are credit only. They have high risk level and high return. They are speculative in nature and often volatile. We have fallen angels. These are previously investment grade. They have high risk level. They are variable and downgraded due to poor performance. We have rising stars, which were previously junk. Their risk level is improving and return is increasing. They are upgraded based on the financial health. We have callable bonds, which are backed by any issuer. They are variable. The return is higher and they can be called earlier by the issuer. So there's the bonds that we've talked about. So we also have non-refundable bonds, zero coupon bonds, perpetual bonds, convertible bonds, and adjustable bonds. So we'll look at coupon bonds specifically. Just want you to understand the concepts behind these ones and we go into the calculations. So when we are discussing the non-refundable bonds, these are simply bonds that can be called or redeemed only if the issuer uses internally generated funds like profits and reserves, not from issuing new bonds. So the features are that if interests fall, the issuer cannot refinance the debt by issuing new bonds at a low rate. So this protects investors from early redemption due to refinancing. So this one offers a predictable income for bondholders. So the advantage that investors have is that the non-refundable bonds are more secure than callable bonds in terms of stability. Where the putable bonds or put option bonds, they give investors the right to sell the bond back to the issuer at a par value on specific dates before maturity. So these protect investors from rising interest rates or deteriorating issuer credit. So they offer downsizing protection, which is especially useful for volatile markets. We also have what we call perpetual debentures. Perpetual debentures. So perpetual debentures, these are bonds that have no maturity date. Okay, these are bonds that have no maturity date. They continue to pay interest indefinitely unless the issuer decides to redeem them. So they pay interest rate forever until or it is voluntarily redeemed. So the principal never is never repaid unless a bond is called. Often it's issued by government or financial institutions. We also have a zero coupon bond. A zero coupon bond is a bond sold at a deep discount and they do not pay periodic interest. Instead, the investor earns a return with the difference between the purchase price and the maturity value. So these ones have no interest payments and the full return is realized at maturity and they are sensitive to interest. Okay, so these are what we call the zero coupon bonds. So we also have some bonds called Convertible bonds. These can be converted into the issuer's common shares. So these are common bonds today, which investors are liking because in these convertible bonds, you give investors an option to convert their bonds into a specific number of common shares. So it includes a conversion ratio of, say, 10 shares per bond. It has a conversion price and conversion value. So it pays regular interest until the conversion. So it offers an upside potential for the issuer's stock. So we also have adjustable bonds. Adjustable bonds are bonds that have interest rates that fluctuate based on the benchmark index. So we have floating rate bonds, variable rate bonds, inflation indexed bonds. So these bonds protect investors from interest rate risk and inflation. Okay. We also have what we call structured securities. So structured securities, um, rather customized debt instruments that include embedded options or features, the combined characteristics of different types of bonds. They may be callable, puttable, convertible. So they include warrants, derivatives, and custom payoffs like indices and currencies. So we also have warrant bonds, which include warrants that will give the holder the right to buy the issuer's stock at a fixed price. We also have credit-linked notes. These are payoffs. Now, let's look at corporate bonds risks and how we calculate um, these in the bond market. Okay, corporate bond uh, risks. So when dealing with corporate bonds, these are debt securities that are issued by companies. They are not issued by governments. So they offer higher returns than what government actually will offer. They come a lot with high risk, especially the risk of default, because companies are fallible. Government is rarely fallible. So um, their risk, however, can be reduced for certain investors depending on their strategies they employ. So some of the strategies include covenants, which are legal clauses in the bond contract that is designed to protect investors by restricting certain actions that the issuer may have. Okay. So these are some of the things. So the types of covenants that we may have, what we call affirmative covenants that will require the issuer to maintain a specific financial practice. We have negative covenants that will prevent the issuer from taking actions like taking too much debt. And we also have what we call a bond insurance. A bond insurance is a guarantee from a third-party insurer, usually a highly rated financial institution, that will ensure that the bondholders will receive their interest and principal even if the issuer defaults. So this kind of effect on risk is that it reduces the credit risk on the investors and would enable the issuer to offer lower interest rates. That is another uh, intervention that comes in managing risks. So we also have what we call sinking fund provisions. Sinking fund provisions. What are sinking fund provisions? So it's a provision that requires the issuer to set aside some money each year to repay a portion of the bond before maturity. So how it works, it reduces the final repayment burden. So it will minimize the default risk by ensuring that the issuer doesn't wait until the last minute to repay the amount. Okay, so the benefit that the investor will have is that it increases the bond security. So that is what we call that. So what have we talked about? Talked about corporate bond risk mitigation tools. So we use covenants. The purpose is to um, ensure there are contractual controls on the issuer's behavior. So the benefit to the investor is that to maintain the issuer's creditworthiness. So we also have another version which is called the bond insurance, where the third party will guarantee payments, which will lower risks of borrowing to the investor. And lastly, sinking fund provision, whose purpose is to spread out the repayment of the principal to reduce the default risk and stabilize the cash flow. So we go into the international markets. International markets, we're dealing with foreign bonds, euro bonds that we are famously acquainted with in Zambia. What is a foreign bond? A foreign bond is simply um, issued by a company or government in a country other than its own and in its country's currency. So it's subjected to regulations of that country in which it was issued. So here, investors typically are domestic to the country of issue. So, for instance, a Japanese company will issue a bond in the UK, in UK dominated British pounds. So this is a foreign bond in the UK. All right. So the nicknames that we have for bonds, we have Yankee bonds, which is a foreign bond in the US. We have Sumarai bond, which is a bond issued in Japan. We have a Bulldog bond, which is a foreign bond issued in the UK. These are some of the nicknames. Then we also have Euro bonds. We've heard of a Euro bond. A Euro bond is what? A denominated um, is denominated in third-party currency. So Eurobond is issued in a currency that is not native to either the issuer or the country of issue. So it is usually less regulated than the domestic or foreign bond. It is traded internationally and may be listed in multiple markets. So Eurobond is popular for multiple corporations and global investors. For instance, a Japanese company may issue a bond in London dominated in the US dollar, or like the Chinese issued a bond to Zambia in US dollars. So neither the issuer, China, nor place of issuance in Zambia use their domestic currency. So that's what we call a euro bond. So what have we talked about? We've talked about types of bonds in terms of comparisons between a foreign bond and a euro bond. So currency for the foreign bonds is that the currency is in the country of issue. So if you're giving a bond as Zambian outward, it will be in kwacha, whereas the euro bond is in the third party's currency. You can use US dollar. If you're dealing with the US, you can use it in British pound. So neither of the countries is using their own currency. In terms of regulation, the foreign bonds are subject to the local laws of the issuing country. So if I'm issuing a Zambian, it will subject to Zambian laws. Whereas Euro bond is less regulated, it's more flexible. All right? Are we flowing together? Are we flowing together? So now let's look at some of the um, questions before we proceed to the calculations. Define a bond indenture. What is the role that a trustee plays? So a bond indenture is a legal contract that outlines terms of the bond. The trustee will ensure that the issuer um, complies with these terms. How does sinking fund provision reduce investor risk? Okay, what are protective covenants? So let's look at some of the calculations that we have in this topic regarding bonds. Okay, suppose we have a bond of such a nature. So we have the value of the bond, the coupon bond is given by a coupon value I times the present value um, annuity factor plus a face value multiplied by the present value interest factor F. So the coupon bond here has three features. The maturity value is a face value, the value at which the bond was issued, usually 1,000. So if the bond was issued at 1,000 kwacha, that is a face value. If the bond is sold for 2,500, it is a premium bond. If it's sold for less than it was issued, it's called a discount bond. We also have what we call the coupon interest. Coupon interest is the interest that the issuer is expecting on the bond. So if we have an 8% coupon bond, 8% of 1,000 gives us the coupon value, capital I. Capital I is a percentage value of the interest. So capital I times the face value. That is what we call the coupon value. So 8% times 1,000 is how much? 8 equals. So capital I is the coupon value. Then we have R or KD is the market rate or the discount rate. The discount rate is used to calculate the present values. So if the discount rate is more, if the coupon interest is more than the discount rate, it's called a premium bond. This is the ideal situation. So if your more I is more than what? The market rate, this is called what? A premium bond. If the coupon rate is equal to the um, market rate, it's called a par bond, meaning your face value is the selling price. However, if the coupon interest rate is less than the market rate, then we call that a what? A discount bond. Are we together? Are we together so far? Are we following?
Yes, 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 yes. I'm following.
So now we need to calculate the what? The value of the bond. So the present value factor is given by 1 plus kg. Okay, 1 plus kd, the power time. So suppose this is a 3-year bond. We need to calculate the value of the bond. So we'll start here. What is the value of the bond? What is the value of the coupon? Value of the coupon is small I times the maturity value. So 8% of 1,000, that is 8. Okay. And what is the face value? Our M, that is 1,000. Then what is the interest factor? We substitute in here. 1 over 1.10 to the power 3. So that is the interest factor. What do we get? What do we get there?
I didn't have a calculator. Let me try. So that's 0.7513.
So 0.751. Then the annuity factor is given by 1 minus present value factor over R. So 1 minus 0.751 divided by what was our R? 10%. What do we get?
It's giving me a minus 6.5.
No, 1 minus that equals, then you divide by that. 3 point something.
Okay, 2.49.
2.49. Okay. So now you substitute these factors in here. So on the annuity factor, put 2.49. On the interest factor, we put 0.751. So what we get as the value of the bond?
Okay, so it's 950.2.
950.2. So what kind of a bond is this?
So this
The discount what?
discount bond.
Yes, a discount bond. All right, the discount bond. So we have seen that it is selling at a less what? Less price than the um, original. Okay, so you need to understand how to um, calculate based on the information that has been given. Okay, so let's look at another example. I want to get the exam question. And before I go to the exam question, let's look at another example. Suppose you're given a bond with the following features. Find the value of a 5-year bond. 5-year bond at par 1,000 kwacha and coupon interest 15% and market rate 7.5%. Okay. Find the value of the bond if it's annual bond and semi-annual bond. B, semi-annual bond. So what are we given in that data? What's the value of the bond?
We are given 1,000 kwacha.
1,000 kwacha. Yeah, that is our
We are also given
the time. What is our time?
5 years.
5 years. Okay. So how do we find the coupon value? The capital I? Capital I is what?
we multiply the small I by the par value
Yes, what is our small I in this case?
by it's 15%, 0.15.
Times 1,000. So what becomes our coupon value? 150. All right. So you put the 150 here. Okay. Then how do you find the interest factor first? One over what? 1 plus R. So R is what? 7.5%. 1 point. 0.75 to the power what? 5. What are we getting?
That's a 0.697.
So where does this one go? Here. 0.697. And how do we find the interest annuity factor? 1 minus the interest factor divided by what? R. So subtract what is 1 minus 0.67? 1 minus this answer divided by the 7%. How do we get? Divided by 0.75%. 0.075%. How do we get?
We are dividing by 0. Point what?
0.075. Okay, so the answer that you find here, you put it here, then you solve it. That is how you find the annual bond. Semi-annual, you divide the interest rate by 2 and the time by 2. So I want you to find the semi-annual bond at your own time. I found the annual bond
I found 4.04.
4.04. Then you evaluate. So we end here for now. I'll send you questions based on what we have learned today. So this will be a premium bond because this is higher than that. So it's a premium bond. It's not a discount bond.